So far, we have seen how in finance we can calculate the risk and return for any asset or security. However, what investors and managers want to know when deciding what investment to take on is what return would they get in the future from such investment. The decision to invest or not is based on this knowledge of what is the expected return of an investment. It doesn't do us much good to know what happened yesterday. We need to know what will happen tomorrow. The downside is that these expected returns are unobservable. They are not 100% certain. There are guesses and estimates based on historical prices. These are the methods used by analysts to estimate expected returns: historical, probabilistic, and risk-based approach. With the historical approach, past data is used to find the expected return. We've seen that for the last 100 years, Aussie shares have had an average return of about 7.3%. Taking in consideration a few other factors, we would expect a return in the future around the same level. For example, knowing that the current risk-free rate is 2% and Oroton's historical risk premium is 11%, then we can calculate Oroton's expected return as 13%. The limitations of this method is that past data is not a true indication of future returns. Maybe there are technological improvements in the company to improve the earnings. Maybe the industry has become more risky and therefore future returns should reflect different conditions than past returns. Also, if a company is a young startup firm, they lack the long-term record to base their expected returns on. The second method of calculating expected returns is the probabilistic approach. Here, all possible outcomes of returns are identified, and the probability is assigned to each outcome. The expected return is the sum of all possible outcome returns weighted by their respective probabilities. For example, in the Oroton case, analysts first make assumptions on the future state of economy and assign a probability to each state. They believe the economy has a 20% chance of recession, 70% probability of expansion, and a 10% chance of boom. Based on those assumptions, they expect Oroton to earn a negative 30% in recession, 15% in expansion, and 55% in boom. The expected return is then the sum of weighted returns by their probabilities. From this, we can go on and calculate the variance of those returns using the probabilistic approach as follows. The drawback of this method is that it requires estimation of all possible future outcomes for the assets and then assign a probability to those each outcomes. Where did those probabilities come from? Where did these possible future outcomes come from too? All these estimations are based again on historical experience and past data. For example, if a recession occurs in 1 year out of 5, we can assume a 20% probability of recession. Now, before we discuss the third approach of estimating the expected returns, the risk-based approach, we must take a detour first that will lead us to the same destination. So far, we've been dealing with a single asset, and we've been looking at measures of returns and risks relating to a single asset. We now extend the analysis to examine the effect of holding a number of assets. So a portfolio is a collection of 2 or more assets. Each asset's risk and return in the portfolio plays an important role, as based on how much is invested in each asset, it can affect the overall risk and return of the portfolio. So the way we structure our portfolio or the weighting of each asset in the portfolio will enable an investor to reduce the overall risk. As with a single asset, the risk and return of a portfolio is measured by the portfolio expected return and standard deviation. The expected return of a portfolio, therefore, is the sum of weighted expected returns of the securities in the portfolio. Let's look at this example, where we have two assets of equal weight in the portfolio, Coles and Telstra. Coles has a 15% return and a standard deviation of 12%, and Telstra has a 30% return and a standard deviation of 20%. What is the portfolio expected return if the two assets are invested in the portfolio? Applying the formula, we find the expected return of the portfolio to be 22.5%. You might be inclined to use the same concept to find the standard deviation of the portfolio. However, that is wrong. We need something else here to find the risk of the portfolio. We need to know how the assets co-vary or correlate to each other. In fact, assuming the correlation coefficient between our two assets is 0.1, and taking that in consideration, we find that the standard deviation of the portfolio is actually 12.6%. Note that if we would had only Telstra on its own as our only investment, although the return is high at 30%, the risk is very high as well at 20%. Or if we only have Coles as our investment on its own, we receive a lower return of 15% with a risk of 12%, a lower risk. However, by investing them together, adding these two low correlated assets into a portfolio, the portfolio return becomes 22.5, which is higher than 15, and the risk remains around 12%. So we actually increase the return and maintain the lowest risk possible. By looking at this table, we see that the more assets we have in the portfolio, the lower our risk becomes in column 2. However, no matter how many shares we add, the risk will not reduce further. This leads us to what we call diversification. Portfolio diversification is the investment in several different asset classes or sectors in order to reduce the risk and to increase the returns at the same time. Note that diversification is not just holding a lot of assets. For example, if you own 10 internet stocks, you are not diversified. However, if you own 10 stocks that span 10 different industries, then you are diversified. Remember, we said risk and return have a positive relationship. You cannot derive high return without bearing high risk. However, by combining assets in a portfolio, we can maintain a reasonable return and at the same time decrease the risk. How is this possible? Because of the covariance or the correlation between assets. That is the key of risk reduction. By combining assets with negative correlation, we are able to reduce the risk of the portfolio. And that's what portfolio managers and fund managers do. Their goal is to pick the assets that have negative correlation between themselves and work out the appropriate weight of each asset in the portfolio that will give the highest return for the lowest risk. But as we've seen in the previous table, risk reduction is possible up to a certain point. The risk that we diversify away is called diversifiable risk or unsystematic risk. The risk that remains no matter how many stocks we add in the portfolio is called non-diversifiable risk or systematic risk. So this systematic risk is the risk that affects all assets and is also known as market risk because it includes things that affect the market as a whole, such as changes in the GDP, inflation, interest rates, and so forth. The unsystematic risk is that risk that affects a limited number of assets, also known as unique risk because it is an asset-specific risk. It is specific only to a particular company or industry, and it could be things like labor strikes, part shortages, a lawsuit, industrial accidents, and so forth. And that's what this figure shows us. If we have only one asset, the risk is quite high, around 12% on the vertical axis for the standard deviation. But as we add more assets in the portfolio on the horizontal axis, we can reduce the risk, but only up to a point. So the diversifiable risk, or the unsystematic risk part, is the risk that can be eliminated by combining assets into a portfolio, because this type of risk is a unique risk or asset specific. For example, if we hold only one asset or assets in the same industry, then we are exposing ourselves to risk that we could diversify away. And we are left with only non-diversifiable risk, the risk that every asset is exposed to because it affects the whole market. So the total risk is made up of systematic and unsystematic risk, non-diversifiable and diversifiable risk. So far, our measure of risk has been the standard deviation, and that is a measure of total risk. However, we've seen that if we have a well-diversified portfolio, we eliminate the unsystematic risk, which leaves us with only the systematic risk. Therefore, the total risk of a well-diversified portfolio is equal to its systematic risk, which leads us to the systematic risk principle, which says the return on an asset depends only on the systematic risk of that asset. Earlier we said that there is a reward for bearing risk. However, there is no reward for bearing risk unnecessarily. In other words, you are not rewarded for bearing unsystematic risk. Why is that? Because unsystematic risk can be diversified away. Therefore, your reward, the returns that you get from holding an asset, comes only from bearing systematic risk.